Now, when I explain the short run beginning next week, okay, you will see that I will start talking about financial sector as well, especially when I'm trying to explain the most famous model in macroeconomics, and that is called the ISLN. If you don't know now, it's fine because we haven't explained that. But there is the most famous model in macroeconomics. It's called the ISLN. So when I'm explaining the ISLN, I have to talk about financial sector. Why? Because I need to explain to you the decisions of public or household in terms of choosing between holding the currency or not holding the currency. Meaning whether you want to hold the money or you want to put the money in certain kind of asset saving, let's say bonds, okay, or put in a bank. So what determines you to decide? Let's say you have 100, I don't know, let's say you have 10 million rupiah, okay? So how do you decide out of the 10 million, how much you are going to put in a bank or in a bonds or any securities, and how much you are going to put in a cash form? Of course you need some cash because you need to feed yourself, you know, you need day-to-day spending, but how much you decide and so forth. And that will shape the IS curve, which I'm going to explain next week, okay? Unfortunately, in the workhorse model, the role of financial sector is very limited, okay? The role of financial sector, among other things, is only like what I just mentioned to you 1 minute ago, to help you to understand how much is currency to be held by the society and how much is the saving, okay? Now, that is much too simplistic, right? Because in reality, especially nowadays, because nowadays we are not only talking about one or two financial instruments like bonds, but there's also stock, there's mutual fund. I think in Indonesia they call it reksadana, right? And then you can buy the stock of a company, and you can even buy a stock of company abroad, okay? So there are a lot more instruments. There are also what they call the derivatives, okay? And of course, some of them are giving you promise of high return. Some of them not promising high return, but you know it's safe. Okay, for example, if you decide to buy government bonds, that's pretty safe, but the return may be not that high. Okay? But if you really want to have a high return, then you buy any mutual fund, but it's not safe. Look what happened with Jiwasraya and all those stories that almost every day now in the newspaper. And that is because customers decided to buy those assets with the hope that they will give highest return, but highest return also highest risk and so on. So unfortunately, the workhorse model in macroeconomics, which I'm going to explain during the semester, at least the third, fourth of the semesters, will not cover that kind of risk in the financial sector. Because in workhorse macroeconomic models, the role of financial sector in general is positive. Of course, financial sector is positive. There is no country or there is no economy without financial sector. You need that. Clear example is bank. How can you have an economy without bank? Okay, then household cannot put their money in saving. Investor cannot borrow money. That means they cannot invest. So there is no business basically if there is no bank. So that is a clear example of the positive role of the financial sector. But at the same time, financial sector can also be dangerous. Again, it so happened that in Indonesia now there's some scandal in Jiwasraya, Bumi Putra, all Taspen, all those kind of things. So you can see that financial sector has two phases. One is positive phase, which is required for the economy, but at the same time also negative phases. What I'm saying here is that I want to caution you that when we talk about macroeconomic models according to the textbook, unfortunately, we are only covering the positive phase of the financial sector. This is the reason why the syllabus in this class is not exactly the same with what the textbook indicates, because I want all of you, the young generation, knows that financial sector has the other phase, which is the negative phase. So we will discuss about the negative phase of financial sector and how it can be linked with the macroeconomics, basically. Okay? Any questions so far before I move to the criticism towards models that we are going to discuss?